Can you hear me?
I hear anything if you're talking.
No, I haven't been.
No, I can't.
Okay.
Oh, okay. Okay.
Okay.
Okay. So I'm going to write in the issue price. So did you see what I did with the calculation here? Did you hear what I was saying? Okay. Okay, we calculated the issue price, which was 3 million. I'm just going to write it in here. 3,456,387. Bonds were issued at a discount, right? We knew that the bonds were issued at a discount because of two things. The stated interest rate that we're offering is 6%, which is less than the market interest rate at the date of issuance. Similar bonds were offering 8%. So we had to discount the bonds, and the issue price was 3,456,387 versus face value of 4 million. So I'm going to do a little calculation over here and figure out the amount of the discount. So
I have a really quick question.
mm-hmm.
For the issue price, is that always going to be the same? The same formula? Is it always 0.4, 20, 1200, or 120,000 and then 4 million, or is it just specifically for this problem?
Specifically for this problem, it's this.
Because I'm having a hard time seeing like where the 4% came from.
So the 4% is half of the market interest rate.
Oh, okay.
The 20 is the term times 2 because it's the number of, it's the number of payments technically. And 10 years is the term of the bonds, and you're paying interest twice per year. So you have 20 payments. The 120 was the semi-annual interest paid. And I wrote it down here in words. And then you have your face value. Those will always be what it is in words. So you just have to find the equivalent for the problem that you're looking at.
Okay. Thank you.
No problem. So to find the discount value, or how much we discounted the bonds, we're going to take our face value, which was 4 million. And we're going to compare that to the issue price, what we issued the bonds for, 3,456,387. So in order for people to purchase our bonds and incentivize them to purchase our bonds, we discounted those bonds by the difference. So what's the difference between 4 million and 3,456,387? How much less than face value did I accept when I issue the bonds? How much is the discount?
543,613.
Yeah, 543,613. So we're going to record the first journal entry, and it's to record the issuance of the bonds, and these were discounted bonds. So it's slightly different than what we did with bonds issued at par value, but it's very similar. So the issue date was on December 31st, 2018. Okay. And write a debit, skip a space, and write a credit. When we issue bonds, what do we receive as the issuing company?
Cash?
Cash, yep. And how much cash do we receive?
Is it 4
4 million?
4 million.
So when we issue the bonds at a discount,
Oh, 3.45
Yeah.
million.
So yes, we always receive the issue price. That's how much cash we receive. We had to discount those bonds, so they paid us less up front. 3,456,387 was how much we received when we issued the bonds. What's my credit to? And there's a reason why I skipped a space, because we're going to fill it in with something. What am I going to face value of the bonds? So we're going to credit bonds payable. And what's recorded in bonds payable in that debt account is always for face value, which is 4 million. Do I balance?
No.
No. At this point, I need more debits, right? So my last thing is going to be a debit to discount on bonds payable. So discount on bonds payable is technically a contra liability account. So it has the opposite balance of normal liabilities. Has a debit balance, normal debit balance. And it's a sister account to the bonds payable account, because you look at these two together and it nets to the carrying value of the bonds. So discount on bonds payable for this one is 543,613. The difference between the face value of the bonds and the issue price. So we're going to get into the amortization schedule now. The first date in your amortization schedule is always the date of issuance. So 12/31/2018 is our issue date. On the date of issuance, do we pay out any interest? Have we had the debt outstanding at all? No. So we're just going to say 0. When we issue the bonds, we receive the issue price. We don't pay out any interest yet. So if we don't pay out any interest, that means we've incurred any interest. So our interest expense is also 0. And since we don't pay interest, nor do we have interest expense recorded, our discount amortization when we issue the bonds is 0. The discount balance, and we'll get into the calculations in a second. The discount balance is the initial discount offered. The difference between the issue price and face value, which was 543,613. Over time, what's going to happen to this discount is it's going to be amortized and it's going to decrease. And at maturity, the discount balance will be equal to 0. At maturity, this balance will be 0, because at maturity, we'll be paying back face value. So at maturity, the carrying value of our bonds will also be equal to face value. For the bond carrying value, the initial amount that we're going to have in this account, or sorry, in this part, is always equal to the issue price. That's our initial bond carrying value. 3,456,387. With these amortization schedules, it's really important that you double check your numbers because you're going to be using these numbers throughout. And if you make a mistake at the top line, then it's going to trickle through. So the first date is always the issue date. The second date is always, if it's semi-annually paid, 6 months after the issue date. So the first semi-annual interest payment date is June 30th, 2019.
Professor, I think your computer battery is running low.
Again, wait 1 second. No, it's charging, but thank you. Okay. I think that I included, okay. For the calculation for interest payment, we're going to do it over here. So this is column A. Semi-annual interest payment equals face value, the bonds issued, in our case, it's 4 million, times the stated interest rate, and we were offering 6% interest per year, times 6 months divided by 12 months, or 1/2. We're paying interest every 6 months for the same amount. So I don't have to calculate the interest payment 100 times. It's always going to be equal to 3% of $4 million or $120,000. So what I wrote above was this calculation, face value times the stated rate times 1/2. That's how much cash you're going to pay out in interest. For column B, it's slightly different. The amount of interest expense that we're going to incur is also going to include amortization of that discount. So we're going to slowly be increasing the amount of interest expense that we're going to record as those bonds mature. Because over time, this discount balance needs to go to 0. So to calculate the semi-annual interest expense, so the amount of interest we're going to record in the income statement, we're going to take the preceding bond carrying value times the market interest rate times 6 months divided by 12 months per year. So we're taking into account that market interest rate here, and we're going to multiply that market interest rate of 8% times 1/2, and we're going to multiply it not times the face value, but times the preceding bond carrying value. And that's why I wrote beginning balance of E. So it's the line above the carrying value before we've incurred this interest. So the preceding beginning balance that we have. In this case, it's 3,456,000. $387. And this is going to be our 6/30/19 interest expense. So we know that our bond carrying value is going to be increasing slowly as we reach towards maturity, because that discount is slowly going to be decreasing. So over time, we're going to slowly be expensing more and more in interest as we amortize that discount and we include that interest expense, the interest paid. How much are we going to record as interest expense on 6/30? Round it to the nearest dollar.
Round up or round down? Just whatever. Or round up to the nearest dollar?
If it's 50 cents or above, it's going to be rounded up.
It's 138,255.
Yep, 138,255. Part of that is the interest paid. The other part is the fact that we received less than we're actually going to have to pay back. So the next column is our discount amortization, and it's the difference. Notice that it's blanking on what that's called. Absolute value. Absolute value of the difference between the interest paid and the interest expensed. So it's going to be a positive number. So 120 was what we incurred in interest or paid in interest, and the amount that we recorded as interest expense was 138,255. 18,255 is how much we amortized the discount this period. And we're going to subtract that amortization from the discount balance. So beginning balance of D minus C. So 543,613 minus 18,255 gives us a new discount balance of 525,358. Sorry.
So, Professor, wait, the first three values, A, B, and C, they don't ever change between installments, do they? Or between payments?
A does. A does not change. B and C will change.
Okay.
If you're using straight line, they would never change. But when we're using the effective interest method, they will always change, because we're looking at that bond carrying value, and that bond carrying value, regardless if it's a discount or a premium bond, is changing each period. And slowly, if it's a discounted bond, it's going to be increasing the amount that we're amortizing it. So what happens to our bond carrying value? It's going to be inching towards face value. So we're going to take our 3,456,000, our beginning balance of our bond carrying value for this period. We're going to add the amount that we amortize that discount, 18,255, and our new bond carrying value is going to be slightly higher at 3,474,000.
So when it says beginning balance, it wants you to continue to reference the balance from the issue date?
No,
Like
it's
the
going to
balance.
reference the balance that's right above it.
Okay, got it.
That's
got
why I said it was hard to do it with the like formula at the top. It's the balance above.
it. Okay.
Okay, so the next date, actually, before we get to that, let's do the journal entry. So 6/30/19 is our first semi-annual interest payment date. And you're going to use your table that you have. Write one debit and skip a space, write a credit. On 6/30, we pay interest. So we're going to debit interest expense because we've incurred 6 months worth of interest from December 31st until June 30th. And this is going to come from column B. 138,255 is what we're going to include or incur as interest expense this period. And we're going to credit cash because we're paying out cash, right? On this date for 120, which comes from column A. We don't balance. And we need to balance, right? So what's the difference between 120 and 138?
18,255.
Correct. 18,255, which is the amortization from C. And we need to credit, and it's not discounting amortization, that's not the account, but we're taking it directly from our discount account. So we're going to credit discount on bonds payable. And it is reduced by 18,255. So the amortization schedule is what we use to help us figure out how much we're going to record in our journal entry. Do you want to try 1231 on your own? Yes.
Yeah.
Sure. So we're using the balance of the last date recorded, correct?
Correct. Okay. How much is the interest that you paid?
That's column B.
So column A. How
Column A
much?
is 120.
Yeah. So you didn't have to calculate that one again. All of column A, you would see 120,000 until maturity date. For the semi-annual interest expense, I'm going to write the formula here because it looks like some of you are still calculating it. But you should have taken 3,474,642 times the market interest rate of 8% times 1/2. And you calculated a higher number than before, right? Because our bond carrying value is now higher. So how much in interest expense are we going to record?
138,985.68.
That, oh, sorry, 138. Yeah, sorry. 138. And then 986. So what happens to my discount amortization? It's going to be slightly higher. The difference between 120 and 138,986 is 18,986, which is going to reduce our discount to what? 506, 372. And now our bond carrying value is going to increase. You're going to take 3,474,000 plus the 18,986. And we now have a bond carrying value of 3,493,628. Do you want me to write out the journal entry again?
Sure.
Okay, so the second date would be 12/31/19. Okay, on this date, we're going to debit interest expense, increasing it for 138,986. From column B, we're going to credit cash because we're actually paying out cash on 12/31 here, and all of the interest related to the same period of time. No accruals. From column A is 120, and we're going to credit 18,986 to discount on bonds payable. So now our discount balance is correct. And we've accounted for those 6 months of amortization. What we're presenting in our balance sheet is bonds payable of 4 million, right? Because that's what our balance shows. And we're going to subtract out the balance of our discount as of 12/31, which is now 506,372. So the bond carrying value at December 31st, 2019 is 3,493,628. If I was to show 2018, you would have seen the 3,456,387. So slowly over time, the liability is going to be increasing because we're amortizing and reducing the discount. You can go on and on. You can finish it off and go through the 20 payments. It's not necessary. And you'll notice in your homework, it's not asking you to do the full amortization schedule. But I do want to show you what it'll look like at the end of the useful life, or at the maturity date. So Oops, looks like I have to open it. Open. Here's the rest of that amortization schedule. At maturity, the discount balance equals 0. So 10 years after the issue date. And at maturity, the bond carrying value equals face value. And it's slowly over time increasing towards face value. You don't have to write this, you don't need it, but I just wanted you to see what happens. So you have about 10 minutes, but I want you to get started on the practice problem. It's in the handout that I told you to print out or download. It's on, I believe it's on page 9-7. And I'll go in here because I want you to have some practice on it while I'm here. Do you guys have any questions on the example we just went through?
Yeah, I have a really good question on the balance sheet part.
Yeah.
For the discount on bonds payable, did you just add up the credits, the total of them, or where'd the
So,
5, 6, 3, 7?
I'll show you it in the T account. I was going to, but I didn't. Sorry. Okay, there we go. So discount on bonds payable, this is what would happen to it. Initially, you have the discount, so this is 12/31/18 of 543,613. On 6/30/19, you reduce this account by 18,255, right? And then on 12/31, you reduced it further by 18,986 because we're amortizing that discount over time. So at December 31st, 2018, our discount balance becomes 506,372. And it's just the 543,613 minus the 2 amortizations we've taken.
And then we got the original discount balance.
The initial,
I'm kind of confused. Like it's in the amortization schedule.
it's in the amortization schedule, but what we did was you take the face value compared to the issue price. And the difference is the discount, the initial discount. Do you see it?
Yeah, there. I see it now. Thank you.
Yeah, no problem. Okay.